Hey, this is John from Whatify, and in this sample scenario we're going to look at a very basic use case of Whatify to model a staff reduction plan. So in these uncertain economic times there, a fictional company here is considering what would happen if their revenue decreases in upcoming quarters. So let's kind of break this one down. In this model we're going to look at cash on hand, basic revenue, basic payroll, three different revenue reduction scenarios and three different staffing reduction scenarios, and that's going to give us a total of 9 different outcomes all running concurrently. Right now we have one of our basic scenarios running here. Now if you're not familiar with Whatify you can connect together a series of those pre-built business logic events. We have a whole library of them, from things like debit, credit, income, expense, banks, and loans, right through to customer growth, churn, campaigns, and all sorts of generative events to model out the financial building blocks of a financial model. Here we're using some very basic ones. In our first event here, this is our cash on hand. In this fictional company, there's $200,000 cash on hand. Currently, right now, this company is averaging $250,000 a month in revenue, and their payroll right now, using an expense event, is $110,000 paid bi-weekly. We're able to look down here at the bottom and make a look at our revenue for $250,000, our employment expenses bi-weekly, so we have the occasional month where there is a third paycheck, and we look at those two together to sort of see our cash flow, both monthly and cumulatively, in this base case scenario, starting at $120,000 and getting to $400,000. Right now we have these other options bypassed right now, and we're locked in with a no change, but let's change that. So the next thing we're going to do is I'm going to remove this lock. You're going to see that there are 3 scenarios calculating right now instead. In one version, we're looking at what happens if our revenue decreases by 10% starting in July of 2023. We're using a modifier event here right now, which is pointing to that upstream income event, the base revenue, those revenue projections, which are currently $250,000, and we're reducing that by 10%, and that's effective July 1st. Now modifiers are stackable, so I can also add a second modifier here afterwards that applies the same 0.9 reduction, but this time it's happening in October. So let's just for a second lock in this scenario so we can look at just this particular model. So here we can look at our revenue, for example, and we can see monthly we had our $250,000, then our first drop, and then our second drop. Right? At this particular stage, our employment expenses are still the same, so what we're able to see overall now is our cash flow cumulatively does have a problem, and this particular company is not going to be able to make payroll as we get into 2024. In a more aggressive scenario where we think that our revenue is going to decrease even more, we can build out a second model here. Here we are saying that it's going to decrease 20% in July and even more, another 30% in October. So this is an incredibly aggressive one where the company is in trouble even sooner and is going to have major payroll challenges into January 2025. So let's turn all 3 of those scenarios on. So all 3 of those are calculating, and we can look at those all at the same time to see through all 3 outcomes currently for this company. And only in the one model where revenue doesn't change are they going to be okay. So now it's time for some scenario planning. We can start looking at some staffing reduction. One is we could do an early staffing reduction where we start as early as Q2 of this particular year and universally just drop our costs by 10%. Just change this number here by 15%, recalculate that. Or we have a second one where we can have a very aggressive staffing reduction plan, 25% right off the bat there in Q3, and then a second one early in Q1 where we take it down by an additional 15% at the same time too. And again, these are stackable. So let's turn some of these other scenarios on. So if we were to do a 15% staffing reduction, we can now see what happens across all 3 scenarios when we reduce our staff by 15%. In this case, 2 of our outcomes are fine, but the third one still has a cash flow problem. So let's turn this off now, and let's see all 3 models running concurrently. And what you're going to see here in a moment now is we actually have 9 different outcomes that are all running at the same time. We can see our income in all 3 models, our expenses in all 3 models, and our cash flow in all 3 models. And in this example here, in 6 of our use cases, we're going to be fine, and in 3 of our use cases, we may have to look at further cuts still. So that's whatifi right now using a very basic model here. In a more advanced model, you might want to use employee events to model out specific employees, and we could have more expenses and other operating expenses in here for a more realistic projection. Again, with whatifi, you're able to lock in some of these decisions here. So maybe at this particular stage, the company decides that they're going to lock in this 15% reduction right now as their current staffing plan, and they're going to keep an eye on their model and see how things play out over time. And if they find the more aggressive reduction is actually happening, then they can come back in this model and make some further changes. So that is an example of a staff reduction model built in whatifi.